Welcome, my name's Jared Cordner. I'm one of the finance client directors at Ashton McGill. And today we're looking at Financial Reporting 101. So it's entitled How to Gain Business Clarity. There's a few things we're going to look at as part of that. I guess initially kind of kicking off at looking at when we talk about the financial reports, being the P&L, balance sheet. There are others, but those are the key ones we're going to focus on. What they mean and what they tell us, how you read them, and then we'll go on. Once we have a bit of an understanding of that, we'll go on and look at the key numbers for your business. And in this, I've highlighted the your business. I can see from those on the webinar today and those I know that there's a bit of a scale in how much time people have spent in numbers with finances, how much people enjoy reading accounts or even consider it reading. Some it's just kind of checking through the numbers. They seem to add up. Let's move on. And for some it can be a bit of a fear, a bit of a mental block. But what we're going to do here today, I'm going to present things. It's going to be a fairly introductory session, especially the first half. So if there are parts of that you're familiar with, that's great. If not, hopefully we'll bring you up to speed. And then on the second half, we're going to do a bit of a case study on a few different actual P&L balance sheets, dive in and see what we can learn. So walk through those as I would if I was to pick them up cold. How would I analyze and review them? So yeah. So yeah, it should be, hopefully it won't be any more than the hour that's booked in, maybe a little less. So as I say, when we run through this, we're going to look at the focus is going to be understanding the story that your accounts tell. And they do tell a number of stories, despite the fact, certainly on Xero, there's no narrative, there's no written words. And I guess the concept here is that these numbers, every figure in your accounts, every figure in Xero it's like a numerical representation of what's happening in your business. Now, the accounts, they take in the realities of the performance of your business, the position of your business, and they turn that all into numbers, into a set of accounts. And the goal today is to be able to kind of reverse that process, look at the numbers, and then better understand the reality, the performance, the position, the stories of your business. So that's exactly what the P&L and balance sheet do. So there's three, when we talk about in a full set of accounts, the core financial reports are the balance sheet, profit and loss accounts, and then the cash flow. We're not going to focus so much on the cash flow as a cash flow statement, but we will have a little chat about the impact of cash, how we monitor cash in the P&L and balance sheet as best as we can. I'll make quite a few references to Xero. I know most of you that are on the webinar, that's the software you use, but the same principles apply across basically all set of accounts you read, whether that's logging onto your Xero, QuickBooks, Sage, whatever it is, or on your year-end accounts. So we talked a little there about the story, and the story that the balance sheet and the P&L tell. So first of all, the balance sheet, when we talk about the balance sheet, it's at a given date, and it's balances on that date. So if I was to ask you, how much money did you have in your bank last year? You'd have to ask me, well, on what day? What day are we talking? That balance changes all the time. And it's the same with the balance sheet. So a balance sheet is a snapshot on a given day. So when we read a set of accounts, when we're starting to understand the story, the opening balance sheet is right, well, what happened? What position were we in at the start of the year? And it's that idea of position, balance. The P&L, on the other hand, then covers a span of time. In this example, we've talked about a year. Doesn't have to be a year. You can run a P&L for a day, a week, a month, 37 days, whatever you want. So we have an opening position, which is read through the balance sheet, performance activity in a year, and then that brings us to another balance sheet, a closing position. What's captured in this P&L is activity in the year. So all your sales, all your expenses, were there staff bonuses in the year? If so, we're going to read those stories on the P&L. the balance sheet is going to show us, as I said, the opening position of the business, what was in the bank, what assets you held, if you had any loans, and then at the end of the year, what the closing position is. So balance sheet is concerned with position at a given day. Profit and loss account is concerned with performance or activity over a set period of time. And we can apply this kind of idea, this balance sheet, P&L balance sheet type concept to any aspect in life. Not that I always do. I'm sure you find that hard to believe, but I like to use an example of a time that my wife and I, we took a trip to Nepal in 2017, and we did a 10-day hike there. You can kind of, you can translate that, you can tell the story through this balance sheet, P&L balance sheet type reading. So we think of the opening position for us on the day that we set off for the hike, 1st of June, £1,000 in the bank. We were feeling pretty healthy, pretty fit, a little apprehensive, nervous, not sure what was ahead of us, and we started at sea level. So that would read as our kind of opening balance sheet, how things looked. Over the next 10 days, if we think of this as our P&L, we walked for 115 kilometers. We spent £700. We ate the same meal for lunch and dinner for every single day, 20 portions of dal bhat. And that kind of captures the activity, the story of what we did and what went on those 10 days. And that brings us to the closing position there. So 10 days later, we'd spent £700, 300 left in the bank, body's a bit wrecked, feeling emotionally pretty pumped, and we were at 13,000 feet by the end of it. So the story there is one that we can track through the business. And accounts, we just go on that cycle over and over again, and that's all there is to these kind of balance sheets and P&L. We have an opening balance sheet, and again, you can pick. I've gone here on an annual cycle. You could do balance sheet, P&L balance sheet on a daily basis. Not many do, but monthly, perhaps quarterly. And last year's closing balance is obviously next year's opening balance. That's how this runs. So we move from one year into the next, and constantly kind of saying, well, where were we? What happened? And then where did that leave us? Okay, where are we now? And you can forecast, well, where are we now? What's going to happen, and where will that take us? So again, the balance sheet all about position, balances, and the P&L all about activity. So that's it on a really high level from a concept. How we go about reading these is a little more complex, and what's included in each of these we can delve into now. Somewhat cheekily, the example we've got here is Enron. It's a famous case of kind of misreporting in an accounting perspective. But I often wonder, I mean, even if it was accurately reported, how many people would have been able to read what was going on and what was somewhat a famous scandal? But if we look at how we read initially, how we read the profit and loss, that's where we're going to kick off. In my experience, most business owners, most people have a pretty good grasp on what the P&L is telling them and how to read it. So we can read here, the first thing to note is profit and loss for the year. So it's for a span of time. That could say for the month, as I've said, for the quarter. In this case, we're looking at it over a year. In that year, what were the total sales? So sales are made up with quantity times price, and that could be over a range of different services, product lines, whatever it is. These are the only two elements there. How many did you sell and at what price? And there might be a mix. Then the next thing we look at then on this P&L is the cost of sales, sometimes called the direct costs. And that is, in order to deliver on these sales, whether that's service or goods, what did we have to pay just to make those happen? So it could be the cost of materials if you're a manufacturing company, it could be cost of delivery, or if you're a service business, it'll be more around the cost of the time it took to deliver that, so production labor or delivery labor. And when we focus just on that, what did we sell and what did it cost to deliver on those sales? It gives us what we call the gross profit. some of you will be familiar with that, but it's a really good indication of how effective you are at turning a point of sale into keeping that in the business. When we add on to that, then overheads, admin expenses, whatever you want to call it, but these are a little more fixed. So if your sales dried up tomorrow and there were no sales, what costs would there still be in the business? So your likes of, for many, it's rent or accountant's fees or whatever there is there. And once we deduct those, we've got this idea of a net profit. When all said and done, at the end of the year, what are we actually, what are we left with from our sales figure? Now, the most common questions I get asked when people are looking at their P&L, they ask, is that good? If this was the P&L for your business, the first question I almost always get asked is, I mean, is that good? Is that profit? If we think of this as a profit percentage, is that good? And that's the first thing they asked. The second that many people get a little hung up with is whether a cost is an overhead or if it's a cost of sale. So I spent money on this, where should that go on the profit and loss? From an accounting perspective, from a tax perspective, in some ways, it doesn't matter hugely where that goes. But in others, it's useful for you as a business owner. It really depends on the story that you're wanting to tell and the detail that you're wanting to pull from the accounts. So this is the structure on a really high level of a profit and loss account for a year. What I'm going to do is run through a few examples of different types of businesses and the different structures that we could see there, different weightings between sales, cost of sales, and overheads, and try to kind of drill down on the ideas that we can find there. What I'm going to do is just chat through how I read these. These are all, as you might imagine, fictional figures, but I'll chat through how I read this and what we can see with different businesses. So if we look at Debenhams here, we've got £200,000 of sales, which is going to be the same across the line. And what that cost them to sell, we talk about their cost of sales is going to be largely the products that they've then sold. Either they manufacture and sell, or they buy in and then they sell. And when they do that, they've still got quite a bit of gross profit. So if you're buying something for £5 and selling it for 20, you think, right, well, we're in the money here. That sounds like a pretty healthy margin. But if we think about that Debenhams model, oh, certainly, I mean, it's the same story up and down the country, unfortunately. But in Dundee, one of the biggest units in the high street, certainly the biggest rents, the biggest rates, and an awful lot of staff that sit in there on these overheads. So the fact that they're buying clothes for £5 and selling it for 20, you need to really make sure that you're keeping up with that, because you've got the rent, the rates, the overheads that are going to come out every single month. What we see in a business like that, where there's a pretty good margin up here, but big overheads, is when sales start to drop, it's really hard to shift these overheads. So in this case, as you can picture, if sales were to drop by 20%, 25%, there's not much they can do about their rent. Debenhams can't just shave 25% off their rent. That they're stuck with this. And so maintaining those sales figures is critical in a business like that. So we see here quite a big weight of, okay, well, they make quite a bit of money on buying an item for £5 and selling it for 20, but they need to do an awful lot of that to make sure that they're profitable month by month, which ultimately they weren't when those sales started to drop. They're stuck with these huge units, huge costs, and they weren't really able to shift quick enough. Next, another type of business, again, all fictional information, but they tell a story. So these are the kind of stories we try to pick up when we're reading a set of accounts. A food distributor, if they were to sell 200 grand's worth of goods, they might only make 25 grand doing it. The margins there are super thin. If they buy a pallet of food for 10 grand, they might be able to sell it for 11, 12. The same kind of idea with car dealerships. So sales figures are incredibly high, but they don't keep much of that money straight off the bat. A lot goes to suppliers. And then they'll have far lower overheads than the likes of Debenhams. They don't have a big retail space on the high street. So it's a different mix here, as we can see, and they're still left with some kind of a net profit. A third kind of examples here is, so we'll talk about Stripe. Some of you will use Stripe in your business, others won't even be aware it exists, but it's a software company, takes payments, takes a small percentage of all the payments it processes. It's a SaaS business set up by two brothers from Ireland. And with a business like that, and why these can be seen as these tech startups can be seen as so desirable is the cost of sales. They could process 10 times the amount of payments that they do in a day, and their costs don't really go up. Once they get past a hurdle rate and once they get past a break-even point, they can scale really quickly, really profitably, and the market works really well for them. So we have here, they could double their turnover in a day. It's not necessarily going to impact the cost of sales. It's really light, the direct costs, but there's big infrastructure in a company like that, big tech support, big software developer salaries, and things just look a little different. So they might think, sure, yeah, we could double our sales, and it certainly isn't going to double our costs. Whereas in the likes of a food distributor, doubling your sales will almost exactly double your costs. There's things move a little differently across these businesses. The final way of illustrating this is with Marks and Spencer's and Lidl, two businesses I'm sure we're familiar with. And people often would think, well, the finances of something like Marks and Spencer's will be better than the finances of Lidl because their prices are higher. They must be making more money. It's not always the case. With this example, I've intentionally sat on the fence to tell a story, but it is again just about reading and understanding the story. So if we think of Marks and Spencer's, their sales again is just price times quantity of what they sell. And they may well be able to take the same apple and sell it for £1, where Aldi could only sell it for 30p, even if they've paid the same for it and it is the same apple. Marks and Spencer's have that. I'm not saying all the food is the same, but they could in this example. So you think, brilliant, right? Well, Marks and Spencer's bound to be more profitable. They're making a whole lot more gross profit than Aldi would, because Aldi don't make as much for their apples as M&S do. The reason M&S can charge more for an apple, certainly there's a marketing spend there that Lidl don't engage with. Physically, the store layout of an M&S, it's nice walking around an M&S. I mean, wide aisles, air conditioned. Lidl's not always the same. I mean, they don't even take the stuff out of the boxes. They just throw it up and let you unpack it yourself. And then when you're at the till, again, the Lidl versus M&S till experience, two very different experiences. And the reason is it's cost. Lidl are focused on keeping this overhead down, keeping as few staff on the ground as possible so that they can sell you an apple for 30p. When it takes M&S, they have to charge £1 for theirs to reach the same kind of profitability. It's a different model, two different stories, the same business. And I guess the key thing here is with your business understanding what the goal is. If we start with a blank piece of paper, how are you going to skin this cat? And it's not necessarily as obtuse as, oh, well, you have to be premium in M&S, or you have to go, like no frills at all on Lidl. It's a little more nuanced than that, but it is worth understanding the consequences of how you position yourself and the consequences of how you structure the business financially, and how that flows through. And the story we'll then see on the profit and loss account. So that's the profit and loss account kind of covered in that high level. We'll come back and do a bit more of a dive into that. But as I said, the concept here is one of performance, of activity over a period of time, whereas the balance sheet is focused on balances at a given date. So as at one particular date, whether it's the first day of the year, the last day of the year, the 15th of the month, doesn't really matter. As you know, with your own bank account, balances change on a day-to-day basis. And broadly speaking, what the balance sheet tells you about is everything you own. And we use the word own there liberally. So you own the money in your bank, you own the assets that are yours. You also own, there's what Xero would call receivables, people that you've invoiced that haven't paid you. That's something you own. We also see then everything you owe as far as taxes, due dates HMRC, payables and kind of trade creditor type bills yet to be paid, and loans, all of these balances, things that you owe. And what a balance sheet does is it says, okay, everything you own minus everything you owe equals the equity in your business. And we'll look a little more in detail at how that works. So as I said, the kind of things we're talking about in these own, and we call them assets in a balance sheet. So fixed assets, tangible assets, people tend to be able to understand pretty well: vehicles, property, equipment, things that you've bought that aren't just expenses. They're there sticking around and providing value for years. Then we have kind of short-term assets, things that are constantly turning over. So these figures, it's not likely that you're buying and selling cars every week, every month, whereas your cash figure will change. The receivables figure, those that owe you money, changes on a daily basis. And stock, that figure changes regularly as well. We talk about these as kind of current assets. Things that you owe or the business owes are liabilities, is the accounting term for these. So payables, loans, VAT, court, these types of things. And in a balance sheet, everything you own minus everything you owe equals this idea of equity. Now, how equity for most people tends to be generated is through profit. So it's the profit that you've raised over this year, last year, the cumulative years. All of that is what goes into building this picture of what you own and what you owe. So there's three ways that we can read a balance sheet, three ways that anything could be funded. And when we come to read the balance sheet, we'll look at those three. So if you were to buy a van, for example, for 20K, there's three options. One, you've just taken cash from the business, minus there, and spent it on a van. Again, you've taken something from here, added it into there. You haven't really shifted the balance of anything. Everything is still in balance. The other option is you've taken out a loan, in which case, okay, what you own goes up by 20K, but the balance of what you owe will also go up by 20K. So again, we're still in balance here. The third option, which is not quite as common, certainly with most of those on the call, is the idea of selling some equity, so an equity investment, so bringing on cash investment. So you could have bought your van again for 20K, and the way you funded that is by selling shares in your business for 20K. It's rarely done, but it is the third option. So this is what a balance sheet tells us, and this balance shifts on a day-to-day basis. As I said, the main way we see this balance being shifted is by profits being generated in the business. So that's a super quick kind of overview on that, the P&L and the balance sheet, and how we start to read them. I don't know at this point, I'll pause at this point if there's any questions, if people want to chuck them into the chat before we move on. But what we'll do in the third section is look at a few real life case studies, some real numbers, and translate that into the numbers that we think you should probably be monitoring in your business. Now with this, it's really hard to speak to everyone that's on the call in specifically. You'll have different questions, come at this with different levels of understanding and experience. So the onus is on you here a little to do some of this work and be thinking, okay, in my business, what's the challenge? What's the story that I want to be given when I read my accounts, however frequently. So if there are any questions at this point before we jump into the specifics, throw them in now. Otherwise, we'll jump in and start having a look at not just the key numbers to monitor, but as I said, the focus on here should be on on your key numbers to monitor in your business, and do be thinking about your own unique position and what it is you need to get from a set of accounts when you read them. What do you want to know? And that's a really useful thing, is to start on a blank page and say, right, forget what's in these accounts. As a business owner, what do I want to know about what's going on in my business, and how can and ask us or whoever it is you're working with, how can you inform me? How can I get this information on a regular basis? So some of the key numbers we're going to look through here is profitability, kind of the idea of a profitability being, okay, you've sold something, how much of that money do you retain in the business? A break-even point, how we can track short-term cash movements and short-term cash demands. We'll do a little bit on dividend levels and the red flags thing to keep an eye out there, and then budget versus actual. We're not going to go through these one by one, but over the next 10-15 minutes, we'll pick up on these points. So first thing we're going to look at is a company called Widget & Co. Now, what I'm going to do is just chat through this as I would if I was reading a set of accounts, and bring you along with me in that. If at any point you have any questions, throw them in the chat and we can pause and pick up on those at this point. So Widget & Co, the manufacturing business, they manufacture something nondescript. And with that, we can see that what this P&L is telling us is their last 3 months of figures. And this is a P&L for the month of February. And then it shows us then the January figures, the December figures, and then the year-to-date figures from the start of their accounting year to the end of February, what things look like. The first thing I would do if I was having a wee look at this is look at this top section first, and the idea of this gross profit. And what we can do is turn this into a percentage. So we have our gross profit percentage. Excuse me. Yeah. And we look at that on a monthly basis. And as I said, often the big question people ask me at this point is when we're looking at gross profits, oh, is that good? Is that a good gross profit? Is that the key thing here is to build a bit of an expectation on what you're expecting your gross profit to be. When you if you don't know at all what you're expecting your gross profit to be, then that's probably a good place to start, is to sit down and rather than looking at actual figures, then right, well, what do we pay for? In this case, the two big things that are driving their cost of sales are the costs of the product that they buy in and manufacture, and then the staff on the manufacturing line that are building this together. And we can see here it gives us a gross profit it shifts a little bit month to month, but ultimately it's around that, somewhere in the 40%, low 40% mark. What that means is for every £1,000 of widgets sold, they keep about 400 quid of that in the business, which carries down then and hopefully pays off their overheads. So that's what we're looking at. Obviously, what we want, the higher the percentage, the better. If for every £1,000 of widgets they sold, they kept £900 in the business, it's obviously better. But objectively, is 40% good? It can't really be answered. We need to do a wee bit of modelling work and set it against expectation. We'll come on and maybe in a wee bit we'll decide if that's a good figure. We can do the same with the net profit. So we can do a net profit percentage. We can see here month by month, sales are fairly variable on their widgets, but the margins don't swing so much, which makes sense because these are direct costs for these. They've got about 45k of overheads every month. And that means on a month like this, where their gross profit is under 45k, but they're going to be making a loss. On a month like this, where their gross profit is over 45k, they're probably going to be making a profit. And we talk about that as the break-even point. So if overheads are 45k a month, how many widgets do we need to sell in a month to have a profitable month? How many widgets do we Anything above that, great, we're in the profit. Anything less than that, we're making a loss. And that's a really useful figure to have in mind for your business. Obviously, it's a little bit estimated, but it does just give you a figure that on a month-to-month basis, as sales are coming in, what level do we need to be hitting to be running a profitable business. So how we'd calculate that is we'd say, right, if we take this estimate of overheads being 45,000, as we can see, and an average margin of around about, we'll use the average margin. So what we do here is we divide the overheads by the margin. That's the quickest way of getting to this figure, and we say, okay, so if we sell 115,000 of widgets at this margin, we'll be left with 45k of gross profit, which will cover our overheads, and that'll be a break-even point. What that gives you as business owners is just an understanding that anything above this is good. So it's a great way of getting condensing all of this information into a single figure that you're then tracking. So it's not the most detailed, but it gives you a figure that's on a really high level. It allows you to kind of manage from intuition from that point on, rather than constantly looking back at specifics on whether this month will be profitable or not. It just is a useful figure to have. So that's something we could look at on a manufacturing business like this. A few questions as I look at this. What we don't see here is a profitability by product. This is pretty high level. It's just saying overall profitability for the business, whereas I work with a number of businesses and they have this down by product line. So we could see profitability by product line, which is great. And the other thing we can't tell from this is what's happening with cash. So in this month, brilliant, we made a profit. Does that mean our bank balance has gone up by 18k? Probably not. So what we're going to do is come on and have a wee look at another example then, which is a balance sheet this time and a new entity. This business is called Zucker Limited, and it's focused on a balance sheet. And what we can see here is, if we think then back on that balance sheet concept, everything they own, so the computer equipment, machinery, in each case it's been a little bit depreciated, but we still have a bit of money there. They have cash in the bank and they're due to collect 10k from customers. So we have here everything they own, and when we deduct everything that they owe, payable, VAT, a wee bit of national insurance, a loan, all in, they're still in the positive. They own more than they owe. So you think, okay, right, fine, we're in a rosy position. When we delve into this and try to understand a bit more of the story, that's not necessarily the case. Timing becomes a really key point here. What they actually have in the bank is five and a half grand, or £5,800. If their VAT is due to be paid tomorrow and they intend on paying that, well, we're instantly down to not very much. Sure, they're still waiting to get paid by customers, but we know that can take a little bit of time. The other thing here, the loan, the timing on repayments there, and perhaps the door's being knocked down by some of their suppliers to pay the payables, and all of a sudden this, okay, we're in a nice position, we've got more that we own than we owe, and everything's fine, can start to feel pretty stressful. This is kind of key, and this is something that the P&L and the balance sheet aren't going to tell you is, well, how does the cash flow look specifically over the next few weeks and months? That's something we do a bit of work with on clients, is a bit more detailed cash flow forecast. And in my experience, it's one thing Xero is not great at. It is doing that within Xero. So it needs a bit more work outside of Xero. We can recommend apps like Float, or even just having some kind of high level view on an Excel sheet. It's really worth looking at. And we go back and we think, okay, that last example for the widgets, they made £18,000 profit in a month. Brilliant, everything's fine. Of that £18,000, £10,000 might still be outstanding and not have been paid yet by customers, whereas they might have had to pay for a lot of that up front. And the cash position is actually looking pretty tight. So it's worth thinking when we read this balance sheet, okay, yep, we have a net asset position, we own more than we owe, surely everything's fine. Not necessarily. Timing on some of this stuff is really important, and that's worth adding into the story as you read it. We'll do one final example here, which is another limited company. And what we're going to look at here is this opening balance sheet. So at the start of the year, here's what the balance sheet looked like. So back in 2021, and at the end of last month, here's how it now looks. Sorry, excuse me, that's the wrong sheet. But it's the same example. So 28th of February 2021, so our opening position, then they had a year of trading, a year of sales, expenses, everything that went with it, and here's the closing position. What we can see here in the year, what have we seen? If anyone in the chat can type in the movements in the year that we can see in this example, what are the stories that we can tell from where they were last year to where they were this year? I'll give you a wee minute to chip in what we can see and start trying to interpret this as a story. Anyone got anything on this one? I'll give you yeah, perfect. So yeah, so we've got someone saying they've grown the business by over 4 times. I totally understand why you'd think that. If we look at this, what was in the cash the bank last year to what was in the bank this year, yeah, so it's 4 times greater. I think brilliant. Things are feeling pretty rosy. Yeah. Now, where's this cash come from? Is the question. A few things. One, a number of you have picked up on spot on. Loan. They've taken a 10k loan in the year, and that's something. Yeah, with the bounce back loan has been a really good option over the last wee while, and something we see with loads of people. And I think it was certainly not a bad idea in this example to take a 10k loan. So sure, yeah, bank's up, but 10k of that they still owe to Mr. Bounceback. Another thing we've seen is as Seamus said in the chat, well, they've just delayed paying suppliers. So at the end of last year, they owed 1.2k to suppliers. At the end of this year, it's 6k. So, well, again, in that 10k, they need to find 6k to pay some suppliers, and all of a sudden that 10k is starting to look pretty thin. Now, as we said in the last example, part of this is about timing and what things look like. The bounce back loan, assuming it is a bounce back loan, it could be a loan shark here knocking the door down, whatever it is. What's the timing on this? If it's a pretty gentle, we have this for 5 years. In the short term, we're not too concerned, but we do know that ultimately we need to be doing something to get this bank balance up over the next while. There's been an investment there. What we can see as well in this is, and this is a bit that's a bit more complicated. The final bit we're going to touch on here is but a little bit around dividends and profits. So what we can see here is last year their accumulated profits. So the relationship between the profit and loss account and the balance sheet is that when at the end of the year all the profits transfer from the profit and loss account over to the balance sheet. So we had, off that, the figure was 150 at the end of last year. At the end of this year, it's 150. I'm telling us that once we account for tax, if there is any, they've made 2k of net profit in this year. So there's been a 2k movement there. That's what the profit's been in the year. So there has been some profit in the year. So if there's been 2K profit in the year, and they've taken on a loan, why is the bank balance not higher? You would think, right, well, if we've made money in the year, how are we in a worse position where we now owe more than we own? And you can see it's been picked up in the chats, is this dividend figure all of a sudden comes into play. There's a few things to pick up on here, and it is technical, but I'm going to spend a little bit of time on it because it's also hugely important and can save headaches when monitored. Dividends can only be paid from profits when profits are made. Now that doesn't necessarily mean that the profit has to be made in that year. For example, they made 150k of profit last year and didn't pay a dividend. They could have taken that as a dividend this year, no problem. So we're seeing actually a big story that came out yesterday was around P&O and the fact that they've been making losses at the same time paying dividends, and people were asking questions, well, how can that happen? It's a little more complex than in a year. If you make a profit, you pay a dividend. You can pay dividends from your historic profits that you never actually paid out as a dividend. But in this case, we can see they made 2k of profit. Well, for 2,150, and what they'll be allowed to pay out as a dividend is this 2,150 figure. What they paid out as a dividend is £8,000. So that's where a lot of this cash is gone. So you think, okay, we've been profitable in the year, plus you've taken a loan, plus you're not paying your suppliers. You seem to have just stopped paying suppliers. We should be sitting on a mountain of cash, but we're not really. In fact, when we add up everything we own minus everything we owe, we're in a spot of trouble here. The reason is it's been taken out as dividends. In this example, if we were to come along at the year-end stage, we'd actually say, first of all, that's not a dividend. Legally, it's not a dividend. We can't call it a dividend in the accounts. We can't tax you on it as a dividend. It's just not a dividend. What we, in this case, would happen is we'd say, okay, we can call 2,150 of that a dividend, and the rest is actually money that the director owes back to the company, or it's a director's loan. So the last 250 minus 5,850. So it's a director's loan in this case. So it's money that the director would need to pay back to the company, or if in the next year, if there's a lot of profits, they could declare a profit, and in lieu they could declare a dividend, and in lieu of taking that dividend out, they could say, well, that'll cover the loan from last year. There's quite a bit of complexity around how that's reported, how that's taxed, but the key thing with all this is when you're in a position where you've got a dividend-driven remuneration policy, if you pay yourself predominantly by dividends, this figure is really important to track. You can only take out as a dividend of the profits you have, and that flags up other questions such as, okay, well, you check in on zero in a month and it gives you a profit figure. Are you sure that's right? That's one of the big reasons a lot of people would get, even if it's a simple business, they want management accounts done internal accounts done on a quarterly basis, so they can just track that dividend level against profit level. For example, one of the things that doesn't happen is on Xero doesn't calculate your corporation tax for you. That's done manually at the end of the year. So throughout the year, Xero will be showing a rosier picture than it is because there's no corporation tax accounted for in that profit figure. At the end of the year, the baddies like Alistair and myself come along, and we hit you with a big corporation tax bill that comes off profit, and you think, oh right, I've been paying dividends based on that last figure. I think there's still a whole lot to be said for paying yourself through dividends. It's obviously there's tax efficiencies there, but it can't be done when you're sleepwalking. We really need to be monitoring that level, that dividend level. So this is, as you can see, what was a fairly simple balance sheet. There's a few stories there of what's going on. So at the minute, as I said, start of the year, we've moved from a position of saying, right, they've grown the business by 4 times to, well, actually, they owe the company money, and from a cash position, things might get a little tight depending on the time flows. So there's a lot to consider, and we're not going to go down every avenue and every route that's every sub avenue off those. But the key thing here is when you go to look at the numbers, that it is something that you're trying to read, trying to interpret, trying to understand. And I'd implore you to use us at Ashton McGill for that when you have these invites to quarterly catch-ups, review meetings. They're your numbers, it's your business, it's you that signs your name on the accounts at the end of the year, and it's you that's going to drive the most value out of the accounts, not It's Mercy, not Company's House. So if you have any questions, if you're trying to have a better understanding of what's happening, really take the time to try to understand what's going on there. As I say, don't be afraid of starting from a blank page, rather than saying, right, let me look to the accounts and then ask questions. That's a great way to do it. I also think there's a lot to be said with not looking at the accounts at all, and before we start saying, right, what do I want to get from these numbers? What do I want to understand? What do I want to be able to read and see? And taking that approach, and then putting that on us, and then how do we get to that position where I know what my most profitable product is, or where there's room to grow, or where my challenges are, if there's tight spots. Sure, you're telling me I'm making all this profit, but I don't feel rich. The bank balance doesn't look good. What's going on? Great questions, and questions which we can answer by looking at these reports. So hopefully that's something today that's taking you a wee bit further down that line of being able to look at the numbers, understand what's going on. If not, if as far as we've got is you have more questions, that's not a bad thing. From my view, that's probably a good point to be as well. Ask the questions. Get in touch. We know that there's those invites to quarterly calls, and build them up. Ask those questions. That's exactly what we're there for, and how we can best support you. So it's always great when you come with questions, even if you think it's you don't want to look like you don't understand something. That's absolutely fine. It's all about just moving ourselves a little further down the line on the understanding. The key point from this, the number of key points, the only big red flag I would say in this is that the dividend level is a really important one. If you didn't understand that, and you are someone that pays yourself predominantly through dividends, let me know. Feel free to send an email or anything, and we can go over that again, because that one is, if there's anything that causes headaches, it's getting that one wrong. So we're keen to kind of support all of you in that journey. If there's any final questions, I'll give it a few minutes to go over that. Otherwise, thanks very much for signing on. Obviously, this is something we're looking to do more regularly in 2022. The question was raised this morning as to whether, well, it was my question. I said if we're going to do any in-person webinars, and instantly realized it's an oxymoron. But if we could do some kind of in-person event at some point, that would be great. But for now, we'll stick with this format once a month on some topics. Again, if there's any topics that you'd love covered, then let us know as well. We want to. I'm not doing this for my own enjoyment or recap, but so whatever you want to know, let me know, let Alistair know, Andy know, and we'd love to respond to what's actually most useful for you. But great. With no questions coming in, maybe call it there. You can have 10 minutes back on a sunny day, and thanks very much for the engagement. And again, any questions, please do just ask.